Hello, everyone. Thank you so much for coming out to the Multicoin Summit and for your continued support. My name is Spencer Applebaum, and I'm a member of Multicoin's investment team. I've been here for about 6.5 years now. Last year, I spoke about our internal framework for thinking about how DeFi protocols can capture value for their respective tokens. In this talk, I'm going to dive into the underlying protocols themselves. Today, DeFi is very capital inefficient across a number of dimensions, but because of its open and transparent nature, it has the potential to be capital efficient tomorrow. Before we dive in, a brief disclaimer, thanks to our legal team. Please note this presentation is for educational purposes and should not be considered investment, legal, or financial advice. So 4 years ago, Tushar and I penned an essay that we called Trade-offs in the Derivatives DEX Space. It was also part of your homework. In that post, we explored the design space for DeFi derivatives, and we created a framework for thinking about the pros and cons of different types of financial constructions. Since that time, a number of new teams have popped up, many with the goal of becoming decentralized Binance. The main teams vying for this today are Drift, who you'll hear from after this, DYDX, Hyperliquid, Jupiter, GMX, and more. There's also a new crop of teams building on top of the underlying derivatives DEXs, including companies like Asgard, Argus, Exponent, and others. Unfortunately, the history of derivatives DEXs has been marked by worse execution quality and speed and liquidity compared to centralized exchanges. As a result, DeFi derivatives volumes have significantly lagged those of their centralized counterparts. As you can see in this chart, derivatives DEXs currently make up only 5% of centralized derivatives volumes. Many note that this is primarily a function of worse speed, latency, and cost. And it's true, because market makers have to pay gas to cancel on-chain orders, and they're generally worried about getting picked off by MEV bots and searchers because of the associated latency. It's important to note that over the history of crypto, CeFi exchanges have operated under a zero-sum mindset. They're able to do so because they control the direct relationship with the end user, effectively allowing them to act as gatekeepers. So if I'm using Binance derivatives, for example, Greg, I know I'm not allowed to use Binance derivatives, but humor me. I'm explicitly depositing capital with them, and for the vast majority of retail users, that means interfacing with Binance directly. CeFi exchanges don't enable cross-margining and netting across exchanges. Even more simply, they don't credit user margin from other exchanges. So if I have $100 of USDC sitting on Deribit, Binance will not recognize that for me. The problem with this generally is that it's quite bad from a capital efficiency perspective. Margin posted at one CeFi exchange does not apply to other venues. As a result, market makers are limited on the amount of liquidity that they can provide per US dollar of collateral that's sitting on each venue. If instead, liquidity providers were able to cross-margin across exchanges and net out their corresponding longs and shorts, they'd be able to provide more liquidity per dollar of margin. And we include a simple example in this slide. So imagine our market maker here, Alice, has 6 positions across various exchanges in varying amounts. In total, she's actually only net short $500 of Bitcoin, but using 1x leverage, she'd actually need to post $60,000 of margin across all of these venues. As you can imagine, that's extremely capital inefficient. So in contrast to DeFi, CeFi is lower latency, at least for now, and it's generally lower cost. However, as I mentioned on the last slide, CeFi exchanges and lenders have problems of their own. They're opaque, they lack standardization, and they operate on a zero-sum mindset, which leads to bad liquidity fragmentation and capital inefficiency. DeFi, on the other hand, its greatest strength is its objectivity and its transparency. In DeFi, every trader's positional solvency is known to all market participants, and the collateral backing traders' positions across venues is transparent. So if Alice is long sole perps on Drift, all traders in other venues can see that. They can also see her maintenance margin levels, her liquidation thresholds, her P&L, etc. Market participants intuitively know that being able to see global-wide solvency and collateralization on protocols like Drift and Hyperliquid is markedly different from the opacity of centralized exchanges. A lot of centralized exchanges refuse to even do proof of reserves, which again is only half of the problem because no one knows what their liabilities are. So the meta challenge, though, is that transparency will only get DeFi so far on its own. DeFi needs to use its transparency advantage to get capital efficiency and offer a more compelling product than CeFi. So I want to take a step back for a second. We at Multicoin take it for granted a lot of times, but I first want to define a few concepts before getting into the thesis of the presentation. Starting with DeFi protocols, we define them as on-chain risk engines and aggregated liquidity. They're lower-level back-end infrastructure. They include things like borrow-lend protocols, AMM exchanges, order book exchanges, stable coins, etc. Higher up the stack, you have front ends. Front ends sit on top of DeFi protocols, and they act as the interface layer for users. A few examples would be UX platforms like Infinex, applications like Necodex, and retail wallets that many of you have probably heard of, like MetaMask and Phantom. In between, and this is important, is middleware. This is infrastructure that helps front ends embed DeFi functionality into their interfaces. A good example would be LeFi, which provides an API for fintechs and other user-facing wallets to enable their users to swap any token for any other token across many different chains. StakeKit would be another example, and they enable front ends and wallets to embed lending functionality into their apps. So the big multi-billion-dollar question, I would argue tens of billions of dollar question, then, is how do we get capital efficiency in DeFi, and DeFi derivatives more specifically? In our view, the biggest opportunity today in DeFi derivatives is portfolio margining, cross-margining, and position netting. And we think that the combination of these will lead to more efficiency. There's realistically two paths that this can manifest. The first path, as you can see here, is a super protocol thesis, which I'll expand on in a few slides. The second path is DeFi prime brokerage, of which there are two hypothetical versions. First, a purely permissionless DeFi protocol, and second, a services business prime brokerage that has a lot of off-chain elements to it as well. And we'll dive into prime brokerages as well in a sec. So the first path, the super protocol thesis, is one in which a singular DeFi protocol launches all of the relevant financial products for end users. This DeFi super protocol would combine several different primitives and designate certain products to be loss leaders to cross-sell users higher margin products. In fact, we're already starting to see this on Solana in a meaningful way. Drift now has the equivalent product suite of Polymarket, DYDX, Aave, Yearn, and Uniswap. Jito, who you heard from earlier, has the equivalent product suite of Lido, Flashbots, and EigenLayer. The idea in this thesis would be that the DeFi super protocol itself enables portfolio margining for their users within the products that they specifically offer. So as an example, a user who's short a Bitcoin perp on Drift would get reduced margin requirements if they were to sell a short-dated Bitcoin put option on a Drift-specific options market. This is because if the price of Bitcoin goes down, their portfolio value would be higher because of the short Bitcoin perp than if they were naked selling the put option. Magically, and this is also important, this can all be done synthetically so as to be maximally capital efficient. In our view, the way that this thesis would play out is analogous to what we've seen over the years in centralized exchange land. Namely, DeFi protocol teams would be the ones capable of doing retail customer acquisition at scale. They'd own the front end, and thus the customer relationship. In contrast, the second path, the DeFi prime brokerage thesis, is one in which DeFi protocols would be the back ends, and it's third-party applications all over the world that own the customer relationship. We envision a world in which self-starter entrepreneurs globally will build hyper-localized front ends and handle things like fiat on and off-ramping, customer support, key management, etc., all while plugging into the underlying DeFi protocols, which we call liquidity layers. This does include incumbent fintech companies like Robinhood and Revolut that want to tap into DeFi rails, and it also includes startups that are more crypto native. More specifically here, the vast majority of volume that would go through Uniswap, Aave, Camino, Drift, etc., would not come from uniswap.org, aave.com, Camino.finance, and Drift.trade. Instead, there'd be a middleware layer, DeFi Prime Brokerage, that connects all of the disparate protocols together in an extremely compelling way, providing maximum capital efficiency for traders while allowing the underlying DeFi protocol teams to focus on what they know and are good at. That includes things like optimizing their financial constructions, reducing latency, focusing on risk management systems, and fine-tuning their products. These prime brokers would sell to both trading firms and retail front ends, and they'd aggregate liquidity from all of the underlying DeFi venues. In this version of the world, users would have very little brand loyalty tied to any single DeFi protocol. Instead, DeFi protocols would compete with each other for the business of having order flow from front ends sent to them. The vectors of competition, which we list in this slide, would be things like liquidity, asset support, risk parameters, latency and speed, capital efficiency, chain support, tokens that can be used for collateral, etc. So a natural question then is, what would a DeFi native prime brokerage actually do? And in our opinion, there are four major functions. First, they do portfolio margining and netting across DeFi protocols. Second, they would enable under-collateralized lending with an ability to permission what happens with the borrowed funds. Third, they do liquidity routing and on-demand fulfillment, mostly for market makers and other liquidity providers. And lastly, they'd enable instant credit to onboard assets into DeFi, collateralized by existing users' DeFi positions. So let's dive into each of these. Our conceptual DeFi Prime would have retail lenders from around the world. The Prime brokerage itself would manage the risk of its counterparties and extend traders credit not based on faith that they'll repay, like Three Arrows Capital sending a one-sentence net asset value statement with a signature to a lending desk, but rather having a systematized view into the positions that they hold in DeFi. They can also dictate what happens with the borrowed funds using smart contracts. The DeFi Prime brokerage can do portfolio margining for advanced traders and market makers, increasing capital efficiency for them. So if a market maker today was to use two derivatives DEXs with offsetting positions, say they have a 10x ETH USDC long position on one exchange and a 10x BTC USDC short perp position on another, our market maker would have to post 10% margin at both of those venues. So she's long $100 of ETH, and she's short $100 of Bitcoin with very little directional market exposure, but she still has to post $20 of collateral. And she gets liquidated on either one in isolation. But what if instead she posted margin with our hypothetical DeFi Prime broker and traded through it? The Prime would know that she has a market hedge on and thus extend her credit that she needs for the underlying derivatives DEXs, increasing capital efficiency for her. Maybe she'd only need to post $5 of margin instead of 20. Furthermore, the Prime brokerage can also have its own risk management systems and thus accept different forms of collateral than the underlying DEXs. For example, a lot of the derivatives DEXs today only accept USDC as collateral, but what if a market maker could instead post a longer tail of tokens with the Prime, who would then go on and provide USDC to the derivatives DEXs for the market maker? This would drastically help a lot of liquidity providers manage their inventories better. So the second piece of what a Prime brokerage could do is under-collateralized lending. Under-collateralized lending in DeFi has been around for 3 years at this point. It's not really a new concept. But the vast majority of previous attempts at under-collateralized lending in DeFi did not permission and whitelist what borrowers could do with the money. V1 of under-collateralized DeFi lending was a combination of A, underwriting credit for emerging market fintechs that have high cost of capital, or B, lending to market-neutral crypto funds and allowing them to move the money with no technological ability to seize assets if things go wrong. This has been disastrous in a lot of cases. And as a result, these protocols have not particularly scaled well. The idea here, though, is that our DeFi Prime can enable under-collateralized credit in a safer way than the status quo offers. So let's imagine for a second that Cinderella here posts $2,000 of SOL margin with our DeFi Prime brokerage. She then borrows 5,000 USDC against it, but she's restricted to depositing those stablecoins into specific on-chain yield accounts that are vetted by the Prime brokerage and whitelisted, and in this case, a Camino lending market. Over time, she earns 100 USDC of yield from the pool. The prime takes its cut of 2 USDC, and the rest of the yield accrues to Cinderella's account with the prime brokerage. Let's assume that things go wrong for a second. If the $5,000 was to somehow reduce in value to $4,000 due to position management or otherwise, the prime brokerage would have the contract authority to liquidate Cinderella by first pulling back the USDC from the yield account, and second, selling off the $2,000 of sole collateral that Cinderella holds with them. This would be to ensure that their USDC lenders get reimbursed. Amazingly, this all magically works because of the elegance of permissioning and clawbacks. The borrowed capital can only go to certain pools that are whitelisted, and when the borrower is at risk of liquidation or creating some sort of insolvency, the prime can liquidate users at layers above the underlying DeFi exchanges. And this is only possible because of the open and transparent nature of DeFi. Not only does that mean that the solvency and collateral of every protocol is publicly viewable, but the code is publicly viewable as well. That makes it possible for the prime broker to do both technical due diligence and financial due diligence on every protocol that they underwrite in real time, which again, in our example, is Camino. As the industry gets more fragmented across layer 1s, layer 2s, layer 3s, app chains, honestly, I can't even keep track of these things anymore. But the notion of a DeFi native prime brokerage in this world that sits on top of underlying derivatives DEXs becomes even more important. Let's say that DeFi protocols wanted to start reducing margin requirements for users that have offsetting positions on separate protocols. The hard part is that those other protocols would need to be on the same chain. There's no way for Drift, for example, to natively read the state of Hyperliquid or vice versa. So the market maker could elegantly do portfolio margining for their traders across blockchains. Taking it even a step further, if the DeFi native prime broker has a strong balance sheet, it can actually provide on-demand liquidity to trading firms across chains. One of the biggest challenges that we hear from market makers that operate on-chain is that keeping capital on a bunch of different chains is extremely capital inefficient. It's made even worse for new chains that haven't really hit escape velocity, because at the end of the day, the only thing market makers really care about is retail order flow. The prime, on the other hand, can maintain capital across all of the chains that they plugged into for all of the trading firms and extend them credit on new chains on demand. The market maker could signal intent to fulfill user orders under certain conditions, and the prime can just execute it for them. It would do so by collateralizing these fulfillments against assets that the liquidity provider holds on other chains with them. And the prime can periodically require the market maker to rebalance so as to not build up too much debt on any given chain. Taking it one last step, we can further imagine a world in which DeFi prime brokers can solve other problems that exist in crypto beyond just capital and efficiency. And let me give a quick example. On and off ramp is one of the biggest issues plaguing crypto right now. It's frequently cited as one of the biggest bottlenecks that faces the industry. It's a well-known phenomenon that card provider on-ramps have extremely low authorization rates for crypto transactions because of the risk of chargebacks. It's not really to any fault of the on-ramp themselves. So let's say here that let's say Alice uses a credit card to buy a meme coin on a DEX. It goes through instantly, and then she transfers the meme coin to a new non-custodial wallet. Later on, she claims fraud on the credit card transaction. She would get refunded on fiat rails, but there's no way, technologically speaking, to actually seize the meme coin that she did in fact buy. But what if our prime broker was able to use on-chain assets that Alice has with them via a smart contract wallet, token extensions, or some other mechanism, and collateralize those funds to automatically accept her credit card transaction? The example we use here is Alice has a $10,000 long SOL perp position with 1x leverage on Flash Trade. She then wants to instantly enter a $2,000 drift bet position to bet on the Bitcoin reserve not happening by end of year 2025, effectively trying to hedge 20% of her SOL exposure. The prime broker, if they're plugged into fiat rails, can instantly authorize her credit card transaction and then one-click enter her into a short Bitcoin reserve position via an embedded smart contract wallet. The margin that she has posted on the left with Flash Trade is seizable for some amount of days to account for the risk of her doing a credit card chargeback, and she can't do anything with that position except sell it and then hold the stable coins in her prime brokerage account. The idea of collateralizing credit card chargebacks with existing DeFi positions that users already have is a novel net new idea that we think will massively improve the onboarding experience into DeFi. So in an end-state economic equilibrium, we think that a DeFi prime could become big and powerful enough such that it starts circumventing the DeFi protocols that it plugs into. In practice, this would mean internalizing front-end order flow into its own native matching engine. A simple example would be Snow White here on front-end A wants to sell one SOL for USDC. Philip on front-end B wants to buy one SOL with USDC simultaneously. The prime broker can monitor on-chain pricing and match them directly, and more importantly, closer to mid-price than if it was to offload the orders onto the underlying DeFi protocols. Once the prime has a large amount of order flow, there's a point at which many users that will have offsetting orders that they can internally route, rather than having to rely on the liquidity of the underlying exchanges. Like Tushar was mentioning earlier, at some point the prime could also have market makers bid directly for the order flow, and then the prime would compare those quotes to prices on chain. So in thinking about the trade-offs between the two approaches, more specifically the super protocol approach and the DeFi prime brokerage approach, we generally think that the super protocol vision is a lot more cost-effective for traders. There'd be no need to shuttle assets around, nor would traders have to pay for explicit leverage from the prime broker. The leverage would be, importantly, implied and synthetic at the protocol level itself, i.e., if you have a long Bitcoin perps position on Drift and you want to enter a margin spot short Bitcoin position on Drift, they would automatically give you reduced margin requirements. Anytime you introduce intermediaries, like a front end and a prime broker, fees are bound to add up, at least more so than if you interface with the DeFi protocol directly. On the other hand, the prime brokerage route is likely safer in the long run. First, it would distribute technical risk across multiple DeFi exchanges. And second, the prime itself would likely have a balance sheet and an insurance fund supplementing those of the underlying DeFi protocols. This approach is likely to be more user-friendly as well, because established fintech companies like Robinhood and Revolut have proven track records in creating intuitive products for end users, while in contrast, unfortunately, the weakness for a lot of DeFi protocol teams is user experience. So our view, and we do feel pretty strongly about this, is that both super protocols and DeFi prime brokerages are going to coexist for the foreseeable future. The name of the game is really customer acquisition, and we see a path where both DeFi protocol teams are able to do retail acquisition at scale, while more traditional fintechs will use prime brokerage and DeFi middleware to serve their user bases. We were actually joking internally recently about this famous quote by Jim Barksdale. There's two ways to make money implicitly in software: unbundling and bundling. The super protocol thesis is an instantiation of bundling, while the prime brokerage thesis is an example of unbundling. We actually believe that the market structure is going to ping pong, in that DeFi prime brokers will end up becoming super protocols. New DeFi primes will then enter the market that aggregate the new super protocols that were previously primes, and vice versa, and the trend will just continue. So I understand this presentation covered a lot, and it was pretty dense for 20 minutes. But I think if there's one key takeaway, it's that DeFi's transparency and objectivity are paving the way for greater capital efficiency than CeFi. Super protocols and DeFi primes are going to help DeFi usurp CeFi across all major metrics over the next few years due to several factors. First, DeFi primes can permissionlessly onboard anyone, whether they have $100 in their account or $100 million. This is wildly TAM expansionary. Second, DeFi primes and super protocols are transparent in real time, enabling market participants to have confidence that they're solvent. CeFi primes do exist at somewhat small to medium scale, but the challenge is that no one has real-time visibility into their books. They also implicitly take on the counterparty risk of the CeFi exchanges that they plug into. Lastly, DeFi and prime brokerages can lend more safely in an under-collateralized way. That's because, via smart contracts and other mechanisms, they can restrict the borrowed assets, seize the borrowed assets if things go wrong, and seize the collateral. So to wrap it up, Multicoin is actively investing across the DeFi derivative stack, And we've done so over the last 3 to 4 years. We're extremely excited to see DeFi super protocols and DeFi primes reshape the narrative for DeFi derivatives and for DeFi to start eating into CeFi's dominant market share. David's going to come on after me from Drift and talk to you a little bit about what they're building and their super protocol. Thank you.